Good day, everyone. This is Aldrin Maynard Ortega, and I'm here to discuss the part 5 of chapter 16 of the Contemporary Financial Management. So, this is a continued discussion of the major sources of negotiated short term credit. In the part 4 of this chapter, the first two are already discussed, which are bank loans and commercial paper. And as for now, I'll be discussing the remaining two, which are accounts receivable loans and inventory loans. So, first off, accounts receivable loans. So accounts receivable is actually one of the most commonly used collateral for short-term borrowing or for secured short-term borrowing. And the reason why most firms commonly use this is because it is relatively liquid, as this can be readily converted into cash in a relatively short period of time. And also, its value is relatively easy to recover at times of insolvency or when the borrower is unable or does not have enough money to pay the debts. So for this loan, instead of physical assets that are hard to handle or hard to manage, it involves documents that represent the obligations of the customer. With those in mind, yes, it can be advantageous, but aside from those, it also has disadvantages. A given example is that a borrower may pledge non-existent accounts, or at the time where the borrower is insolvent, recovery process may be disrupted as he might claim alleging that his return or merchandise or file is defective, and administrative costs can be high in processing the receivables. So there are two ways of using accounts receivable as collateral for short-term borrowing or short-term credit. It can either be pledging the accounts receivable or factoring the accounts receivable. So let's discuss the first one. So when we say pledging accounts receivable, it is using your accounts receivable asset as collateral for the loan and using its proceeds to repay the lender. So to simply put it, instead of paying cash, a firm will pledge its accounts receivable. A significant aspect of it is that the title to the receivables is retained by the firm, and it can still be seen on its balance sheet as the firm continues to carry them, so no transfer of title. Basically, when a firm pledges accounts receivable, it's like the promise to remit payments to the person receiving the pledge as the accounts receivable is collected. So no money is necessarily given at the time of the pledge. Whatever receivables a firm pledges, it promises that they will collect those specific receivables, take that money, and immediately pay it over to whomever it is pledged. But if one is unable to collect the pledged receivables, one is still required to repay the loan, since in pledging accounts receivables, it is with recourse. So that means the seller is still responsible for the uncollectible accounts. This is also notification basis, which means that the customer is not notified that the receivable has been pledged by the firm. So for a company, receivable loans can be a continuous source of financing as long as new receivables pledge our existing accounts when collected. And because of that, it can be an attractive source of financing for firms. The annual financing cost of this type of loan includes both the interest expense on the unpaid balance of the loan and the service fees charged for processing the receivables. So the typical rate of interest ranges from 2 to 5 percentage points over the prime rate, and service fees are approximately 1 to 2% of the amount of the pledged receivables. For this example, we are asked to find the annual financing cost. And here is the formula. AFC is equal to interest cost plus fees over usable funds multiplied by 365 over the number of days of its maturity. So there are three things that we must first compute. The usable funds, interest cost, and service fee. So here's a solution. So let us compute first the usable funds. The two given that we are going to use is the $2 million as the acceptable collateral and the percent to which the pledge receivables are lent by the commercial bank, which is 75%. So that is 75% multiplied by $2 million and giving us usable funds of $1,500,000. Now let's compute for the interest cost. Formula is usable funds multiplied by interest rate and multiplied by average collection period over 365. Our usable funds is $1,500,000. Then our interest rate is 2 percentage points above the prime rate, which is 10%, therefore giving us 12%. And our average collection period is 45 days over 365. So we just multiply that and it gives us $22,192 as the value for our interest cost. Now let's compute for the service fee. The formula is acceptable accounts receivables as collateral multiplied by the percentage of bank charge as service fee. So our acceptable collateral is $2 million multiplied by 1%. So therefore our service fee is $20,000. Now we can compute for our annual financing cost. Just use the values above. Interest cost is $22,192 plus service fee of $20,000 over usable funds of $1,500,000 multiplied by 365 over 45. Therefore, our annual financing cost is 22.8%. Another way of using accounts receivable as collateral is factoring the accounts receivable. So simply, it is selling accounts receivables to a financial institution known as factor. For this, we receive money now in return for giving the right to collect that accounts receivable to somebody else, maybe a collecting agency or a bank. The process begins with an agreement of specific procedures and terms. Under the normal factoring arrangement, the firm sends the customer order to the factor for credit checking and approval before filling it. They have to decide first whether it is acceptable. The factor maintains a credit department to perform the credit checking and collection functions. So when receivables are factored, title to them is transferred to the factor, and on the balance sheet of the firm, the receivables will not appear anymore, since it is without recourse, as contrary to pledging. So when we say without recourse, it means that the buyer assumes the risk for the uncollectible accounts. The general reason why we factor receivables is because we need the money now, and we have these promises of getting money in the future that are worth something to somebody who can afford to wait for the money. So when the firm receives payment from the factor at the normal collection or due date of the factored accounts, it is called maturity factoring. But if the firm wants to receive the funds prior to this date, it's called advance factoring. In factoring receivables, they're going to put a profit to this by charging with a factoring fee. Now let's have an example. For this example, we are asked again to find the annual financing cost. It has the same formula as pledging accounts receivable. So in calculating, we must first compute for the usable funds and interest costs and fees. Let's compute for the usable funds. So the formula is average level of receivables deducted by factoring commission, reserve for returns, and interest on advance. So our average level of receivables is $1 million. And for our factoring commission, we will multiply the average level of receivables to the percentage of factoring commission, which is in the given 2%. So that gives us $20,000. For reserve returns, we are going to multiply $1 million to the percentage of reserve for returns and allowances, which is 10%. So that gives us $100,000. And by that, we can get the amount available for advance before deducting the interest. Our amount is $880,000. The partners required to advance masters and funds at an annual interest rate of 40% in total. So that is the amount available for advance multiplied by 14%, then multiplied by average collection period over 365. So our interest is $20,252. We'll just deduct that to the amount available for advance. Therefore, our amount of funds advanced by factor or usable funds is $859,748. Now let's calculate for the interest costs and fees. So we already have the amount for interest cost and the amount for fee or factoring commission, which are found above. So our interest cost is $20,252 and our factoring commission is $20,000. So we'll just add them. Therefore, our interest cost and fees is $40,252. So we can now compute for the annual financing cost, but that is before and after considering the cost savings and bad debt losses. So before considering the cost savings and bad debt losses, we can just compute it by interest costs and fees over the usable funds multiplied by 365 over the average collection period. So that gives us 28.5%. And now if we consider the cost savings and bad debt losses, we'll just add them. That is credit department savings of $4,000 and average bad debt losses of $12,000. So the total is $16. So now in computing the annual financing cost, $40,252 minus $16,000 over the usable funds of $859,748 multiplied by 365 over average collection period, which is 60 days. So our AFC is 17.2%. So let's have another major source of negotiated short-term credit, which is the inventory loans. It is another commonly used form of collateral for short-term borrowing because it is a flexible source of financing and also it is fairly liquid, like the accounts receivable. So it is given to retailers to buy their stock. It is secured against the stock so that whenever the stock is not sold, it can serve as a collateral. This sometimes happens when the retailers don't have enough to cover the stock they need or may find a discount deal on stock requiring more than the capital they currently have. So before inventories are used as collateral, there are things that must be um, assessed or taken into consideration, which are the type of the inventories, physical characteristics of it, identifiability, liquidity, and marketability of the inventory. Let's discuss these considerations. So first is the type of inventory. There are three types of inventories, namely the input or raw materials, work in process, and the output or finished goods. So work in process is not normally accepted as a security for a loan because it can't be used to an extent as much as raw materials and finished goods since they aren't done yet. So normally, only raw materials and finished goods are acceptable as collateral. Next is physical characteristics of the inventory. So the inventory's perishability must be determined first, wherein inventories that have longer significant physical deterioration are more suitable and acceptable. Those that deteriorate easily or early are likely to be unaccepted. Next is easily identifiable. This is by means of serial numbers or inventory control numbers because when the borrower becomes insolvent and probably defaults on the loan, yet the inventory is easy to be identified, a valid title claim to the collateral can be established and protect the lender from any fraud. Other important considerations are ease of liquidity and stability of its market price. So an inventory where there is little to no change in its price over a period of time is more acceptable. In making a loan secured with inventories, the lender can either allow the borrower to hold the collateral or require it to be held by a third party. If the borrower holds the collateral, it's either under a floating lien arrangement or trust receipt arrangement. On the other hand, if the lender requires or employs a third party to hold the collateral, the lender can either use a terminal warehouse financing arrangement or a field warehouse financing arrangement. So under floating lien arrangement, the lender receives a security interest or general claim on all of the firm's present and future inventory. So in here, specific items are not identified, thus it offers a weak protection against losses from fraud or bankruptcy. So like when retailers or businesses that are product-based uses inventory as collateral, the item or actual item may change constantly. But under this arrangement, it assures the lender that its loan is secured against any new items. For trust receipt arrangement, it is a security agreement under which the firm holds the inventory and proceeds from the sale in trust for the lender. So basically, a lender can advance 80 to 100% of the cost of the borrower's inventory as an exchange for the borrower's promise to repay the lender immediately after the sale of each item as collateral. And it includes the accrued interest. Now, for the second one, if the lender requires or employs a third party to hold the collateral, it is also called warehouse financing. So, under this, the collateral inventories, goods, or commodities may be held in public warehouses approved by the lender or in field warehouses located in the borrower's facilities, but it is controlled by a third party or a third independent party. First type of warehouse financing arrangement is the terminal. So in here, inventory being used as loan collateral is stored in a bonded warehouse operated by a public warehousing company. So it transports the collateral to a public warehouse. Lender is able to exercise control over the collateral only when authorized to do so by the holder of the warehouse receipt. On the other hand, for field warehouse financing arrangement, the inventories are segregated from the firm's other inventory and stored on its premises under the control of a field warehouse company. So inventories are physically separated and are placed under the control of a third party. So, field warehouse company issues a warehouse receipt and releases inventory to the firm only when authorized to do so by the lender. Thus, it might or might not be negotiable. So, in a nutshell, the major purpose of short term bank loans is to meet the firm's seasonal needs for funds. They use the aforementioned items as collateral in order to have enough resources. So, that concludes Chapter 16 of the Contemporary Financial Management. This is Aljon Maynard Ortega saying thank you for watching and have a great day.